Understanding Investments a Few Minutes at a Time by Daniel Dower. From Chapter 4, Investing Nomenclature. Issue number 18, Mutual Funds. A mutual fund is a portfolio of investments split over many owners, managed by a portfolio manager. Mutual funds date back to England in the 1800s and began to be used in the U.S. in the early 20th century. In 1970, there were only 360 mutual funds in the U.S. The industry exploded in the 1980s and 1990s, and by 2011, there were more than 14,000 mutual funds, more than stocks on the New York Stock Exchange. A mutual fund permits a passive investor to have his funds managed by a professional for a fee. Unfortunately, there are many conflicts of interest within the industry. Investors may pay fees to enter or exit a fund, and their broker-dealer may receive commissions for placing an investor in a specific fund, a share of the ongoing management fees, a share of trading fees incurred by the fund, etc. Beyond those direct conflicts, portfolio managers are often pressured by their employers to hold certain investments. After Facebook's initial public offering in 2012, 8 of the top 9 mutual fund holdings of Facebook were run by Morgan Stanley, who happened to be the underwriting for the offering. Coincidence? Not likely. Illegal? No. Portfolio managers often have other conflicts of interest. Bonuses may be based on short-term performance, inappropriate for a long-term investor. Studies have suggested that such benchmarks have a material effect on returns. For example, a manager trailing mid-quarter is more likely to alter his strategy to catch up, since many are judged on quarterly performance. Further, mutual funds often have hidden costs beyond their expense ratio. A 2011 Forbes article reports these additional costs at 2 to 3% above the stated expense ratio, usually less than 1%. Before buying any mutual fund, or working with an advisor who uses mutual funds, do your homework. Exchange-traded funds. Exchange-traded funds, ETFs, are rapidly replacing mutual funds as the preferred investment vehicle for many investors. Some ETFs are actively managed, like mutual funds. Others are designed based on some fixed plan that attempts to mirror other investments. SPY, or SPY, is an ETF that mirrors the SP 500. GLD is an ETF that mirrors the price of gold. Note that ETFs do not track their targets with perfect precision, and in some cases have substantial variations. I do not specialize in ETFs, but my typical advice applies. Before investing, do your homework. Remember that even non-profit Vanguard has many well-compensated executives and directors who sell books and get paid for public speaking. Their products may be perfect for you, but they may not be. One thing is certain, only you will put your interests first. There is no substitute for due diligence. Just to list a few potential misunderstandings, I provided several excerpts from a BlackRock white paper in June of 2013. Quote, first, an ETF investor's costs are typically lower than those associated with the average mutual fund. Close quote. Quote, the total expense ratio may not recognize certain costs. Close quote. Quote, investors often do not recognize that seemingly low-cost ETFs, as measured by expense ratios, could be more costly to own once transaction costs are correctly factored into the equation. Close quote. The essential point is that ETF's true value cannot be captured in its total expense ratio alone.